welcome to a brand new show of Market Makers. 2023 is over, but 2023 in a sense was a year where it really defied the law of gravity. As long as you stayed invested, you've really managed to beat the market. The only thing that underperformed in 2023 was cash. So what is the way forward for 2024? There are elections, there is Fed at play, and there is a whole view on that Indian markets right now are looking slightly stretched in a lot of small and mid-cap stocks. So what's the way forward? To discuss that, to understand that, I've got a perfect guest. His understanding of cycle, markets, and ability to identify the new themes, I think is quite extraordinary. Ravi, wish you and your team and your family a very happy new year. Best wishes for 2024.
Thank you, and wish your viewers a happy new year too, and wish you a happy new year too.
I want to start the show on a vote of thank you, and thank you to you because you've always been a big supporter of ET now. You've always accommodated our interview request, even though you've been busy. Phone utha karke hamesha apne interview kara hai. So thank you very much for that.
Thank you.
So Ravi, the question which perhaps everyone is trying to grapple with is that we've had a great year. Is it time to now take a contra view, take some chips off the table, enjoy the fruits of 2023, or ride the momentum? What should be a very basic approach for 2024?
So, let's flash back to beginning of 2023. We were grappling with rising interest rates in US, rising inflation everywhere in the world, spiking energy prices, an ongoing war in Russia, Ukraine. And you could have easily made a case that this year is going to be very volatile. But while what's panned out is something that none of us expected, which was a straight up line. Clearly, markets don't go according to what we anticipate, and there are two aspects to it, right? One is what market is going to do, and other is what you should be doing. On what market is going to do, again, not being very prescriptive, but what I feel is my reading of the setup is that it's a parabolic move that we are getting into. Like it or not, that's how markets behave. We swing from one extreme to the other. We swung to the one extreme on the during COVID times towards the low, and we are now swinging towards the other extreme. Will that extreme point come at some point in this year? I would say very high probability that's what will happen. And then markets will find its reason to correct. What reasons will come up, we don't know. The known ones obviously are the Fed and the elections and all those things. But there can just sheer valuations can also become a reason for the markets to correct, because markets tend to fall under its own weight. All the known triggers for the current year are kind of getting factored into the pricing. So fundamentally, it is becoming more and more difficult to justify deploying more capital. However, again, these things tend to last longer than what, I wouldn't be so brave to take a contra call that this is where it ends and this is how markets are going to correct, and I will use that opportunity, that correction, to deploy more money. The smarter thing to do is just stay invested, clear up your portfolio, get rid of companies with corporate governance issues, understand what you own and why you own it, because what happens is, as my ex-boss used to say, that worst of mistakes happen in the best of times. So we are entering a phase where we are in a best of times, so the worst of mistakes are going to happen. So you want to guard against that. You don't want to lower your quality standards. You don't want to extrapolate something which is temporary into the future. There will be a lot of transitory wealth creators in this market, and you want to understand what are the drivers of that, and when those drivers cease to be the drivers of that particular wealth generation, you have to exit that. So I think a lot of cautiousness is required, but I would say stay put, stay invested, enjoy the ride. You cannot enjoy the highs of the market without living through some corrections.
Okay. So you think, and if you compare that with the previous peaks, 2008 and the one before that, I'm talking about big peaks which the market have made. Is there a similarity right now in terms of the market valuations, or we are far, far away from what those absurd levels were?
No, I don't think we are anywhere close to those absurd levels. And there are three major peaks that we have seen in the markets. One was the 92 Harshad Mehta peak. Second was the 2001 .com peak.
TMT.
And the third was the just before the global financial crisis. And we are nowhere close in a lot of parameters, whether it is profits as a percentage of GDP, whether it is ROE. It is an improving trend. We are at 14-15% ROE. Our ROEs tend to peak between 20 and 22%. Our profits to GDP has peaked in the past at 7% corporate PAT to GDP. My hunch is this time we will exceed that because our corporate tax rates are lower. The new capex, greenfield capex, is happening at 15% tax rate. So all that will get added. So the business cycle momentum will surely continue for another 3-4 years, is what I feel. However, markets might have moved a step higher, and there might be a need for that correction consolidation to happen at some point of time this year. But I am not saying that economy is going to have a tough time. It's the markets that would have run ahead of itself. That's a likely scenario this year.
When you say markets have run ahead of themselves, how can one template that?
So obviously there are some shorthands to the valuations like market cap to GDP, but that I think is a little bit more. I would say it's not a very strong predictor, but there are other things where essentially the corporate earnings are getting factored 2 years, 3 years in advance. Order announcements are getting factored into the prices. All the positive triggers that we have kind of anticipated are getting factored into the price. So when you start seeing prices reflecting FY26 or FY27 for that matter, that is when you should be getting worried. Valuations are about 1 standard deviation above the average. Can we get stretched to 2 standard deviation or higher? That is a possibility, but that is where one has to be worried about that.
We had Hirenved last week. We had S. Naren yesterday, and they pretty much are echoing what you are also saying, that just because markets have gone higher, one should not sell. Crazy things can happen, and maybe the last hurrah in this bull market is still left. How does one know that this is the last hurrah and this is really the red line? I mean, right now we are saying we are not in green. We are nearing what could be called as that zone between red and green. What would be that indication for you where you would say that, look, my experience and my understanding of history tells me that the risk reward ratio is in favor of selling? What would be that red marker for you?
So there are two things to the valuations in a very simplistic manner. One is the earnings and what are the drivers of those earnings, and second is the multiple. People tend to look at multiple and get scared, surely, but what we have to focus on is the earnings and the drivers of the earnings. Is there enough? Is the growth engine firing in all cylinder? I would say no. There is still a rural consumer that is struggling. There is export market that is struggling. It's not all optimism. There are pockets of optimism for sure. So there is still headroom in terms of growth. There is still headroom in terms of margin levers. So for example, since last 5-6 quarters, our gross margins have been improving, but the operating leverage which kicks in with the higher utilization is yet to kick in. We are at about 75% utilization. As soon as we start crossing 80%, that's when the operating leverage tends to kick in, and the margin expansion can be very, very high. So that lever is still there, and the benefits of all the PLI schemes announced in the last 2-3 years are up ahead in the future. So there is, in terms of profits, in terms of profitability, we have not peaked. Multiple assigned to the current earnings are at a very high level, but the absolute profits are for sure going to grow from here in the next 2-3 year horizon. So that tells you that you stay focused on the drivers of the profits and let markets do its thing in terms of evaluation. I mean, I can never justify a 60 multiple or a 70 multiple, but the fact of the matter is that these things tend to surprise us very, very positively, and any exercise to preempt this is where market peaks usually tends to fall flat. So we stay focused on the drivers of profits, and over there I feel there is still a lot of headroom left in terms of profits growing.
Okay, the mega trends, what you've identified, we've spoken about them. Let's revisit them. Consumer discretionary, manufacturing, energy, financials. So I'll start with consumer discretionary. Stocks are expensive there, whether it is autos or consumer staples. What is the best way to bet on consumer discretionary?
See, consumer discretionary can be, we can put it into many different buckets. So for example, the real estate cycle is going strong and positively. The tourism cycle is growing strong and positively. But if you look at the bottom of the pyramid, the staples, that is not doing so well. So there are various pockets which will do well over a period of time. If India is going to be a $5 trillion economy from the current $3.5 trillion economy, and our corporate PAT to GDP is going to increase, and our per capita per GDP is also going to increase, the discretionary consumption boom still lies ahead of us. It will manifest itself segment by segment, and we have to identify which are the ones that are going to lead from the next 3-5 years perspective. So I feel over here some of the capital intensive tourism related companies are obviously factoring in a lot of positivity, but some of the other bottom of the pyramid kind of consumption plays is something that is struggling right now. And
Can you
those
give
are
an
the
example
places.
just to subset the category?
Yeah, no. So, for example, QSR, the numbers are very weak, and it is expected to be weak from the next 2-3 quarters point of view as well. So, and this kind of a struggling environment, probably the valuations can reach a point where they can start looking attractive from the next 3-5 years point of view. So, that is one thing that we would be very looking forward to. Second thing, probably in the beverages company also, there are some examples where there is no wealth creation that has happened in 5-7 years time, and the consumption, these things tend
Alcoholic
to pick
beverages.
up. Alcoholic as well as some non-alcoholic also, but the point is that the consumption at the the mass level is probably not yet manifesting itself, and it's a theme that is much more secular in nature. So these cyclical downturns are the time to be looking at them.
I'm looking at public information. You've liked manufacturing. The BSE bulk data indicated that you participated in the Keynes IPO when it got listed. The stock is up 4-5 times. But yet you still find value in manufacturing.
So I strongly feel that India has neglected its manufacturing sector for the entire independent era, and this is the first time that a government has shown so much resolve in improving the manufacturing sector. Manufacturing has remained at 10-11% as a percentage of GDP since 1947. Can we go to 15%, 20%? Can we actually move the populace away from the agri and farm oriented economy towards manufacturing and urbanization oriented economy? I think that is definitely the intent, and a lot of positive steps have been taken towards that. The ball has already started rolling. What we are witnessing, and there are many multiple tailwinds. It is one is self Atmanirbhar, but the second part of it is also exports from India, and third is import substitution. So all the three themes in manufacturing are playing out to a varying degree and to different extent in every sector, but it is reflecting in the order books. Order books are all 3-4 years kind of filled out in for future. So the theme is strong and it will continue, and market has also recognized that, and the stocks are pricing in a lot of that. So I am not suggesting for a moment that they are fantastic opportunity at this point of time, and we can obviously have a correction at some point of time, but the theme will continue to do well even from here. You will have to find your entry point, and I am not for a moment suggesting that there cannot be a correction, but we have strong belief that this theme will continue. And of course there's some uncertainty around the election. The priorities of if the government was to change, the priorities can change, so that is the risk we are carrying in some of these sectors. So you have to be cognizant of that, but it's a very small probability, but it is a probability, and you have to build a portfolio beyond the election as well. You cannot be building a portfolio where a particular event can see entire portfolio fall 40-50% kind. So you will have to calibrate a little bit, build a mix of themes that are not dependent so much on government policies as well.
Would it be a good idea to raise, let's say, 15-20% cash ahead of election, then come back again, maybe at higher levels, but you need to have that cushion?
I wish I was that smart and I could time that to the precise saying that no, this is where markets end and this is where markets should start correcting. And I would want to be able to do that, but my past experience tells me that I'll just give you one anecdote where a very smart person called the COVID peak in February of 2020, and honestly at that point of time none of us were speaking about COVID being such a large thing. And he was right. He sold out his entire portfolio. And in a month's time, he was proven right, where it was down, the entire market was down 40%. However, 3 months down the line, every stock that he sold was above his price and he was never able to get in. I'm not suggesting something like that is going to happen, but I am saying if you get the correction right, you will not get the entry point right. It is the smarter thing, the wiser thing to do is stay put, reduce the risk in your portfolio by getting rid of the lower quality names, and expect some volatility and lower your expectations. That's what I would say.
We'll bring that quote which has inspired Ravi, and we'll just pull that quote out just to just to supplement the point here. And it's a quote where I'm going to quote him. It never was my thinking to make the big money for me. It was all about sitting. So that is what you're planning to do.
So see, markets are designed to scare you out of your investments. But in real estate, do you think that way? When you purchased a piece of land or a flat, you will hold it likely for 10, 20 years. You're not going to sell because it's gone up 20%. So entering and exiting is not so easy in real estate. Now, just because it's easy to do that in stock markets, the corollary to that is people tend to get shaken out of their investment far more than they should be. So sometimes valuations will be an issue, sometimes war will be an issue, but there will always be reasons why you should be selling out of your position. And the biggest risk that you carry is not participating when the markets are good, when the times are good. Yes, you have to keep your head and think rationally, but again, most of the times, not doing anything is the right action. Even when times look like they are a little on the optimistic side.
So Ravi, the dilemma for a lot of folks who are watching the show is that, look, we've got it right in 2023. We followed you, we followed other market gurus, our portfolios are up 50%, 70%, some of them have also doubled in individual stocks. Let's say you identified a mega trend, and I'm using this for just discussion purposes, Keynes. It's up 3-4x from its listing price. You see the mega trend in making, but the stock has already run up. Then what do? Sit on it? Or you say, look, 3-4 times is what you will get. It's time to cash out. How do you really identify this art of multi-bagger and sitting on it?
Yeah, so I go back to what I mentioned earlier about the drivers of profits and profitability. And you have to understand how large the opportunity is and does that company have the right to tap into that opportunity. If we are talking about a beginning of a trend, let's just, I'll give you a slightly older example so that,
Give me a current example.
No, I'll give you a slightly older example. Imagine you are, this is early 90s, 94, 95, and IT stocks are just about beginning to perform. You are in 95, 96 where, stocks have gone 3x, 4x, 5x, and you are feeling scared about, what's going to happen now. And you sold out too early. Look at the kind of wealth that got generated subsequently. So was it the smart thing to have focused on the 95, 96, that year's earnings number and multiple and say that, one should be selling out? Or was it the smarter thing to just stay invested? This is a longer term 10-year, 15-year trend, and there is going to be a Foxconn out of India, a Honhai Precision, or those kind of companies will be built out of India, and you might have actually gotten a chance to get into one early enough. So then ride the volatility. Titan didn't become Titan without its share of corrections. It had more than 50% correction. It had more than 10-20% correction. So you want to make money you want to generate wealth, then you have to develop the ability to stomach the volatility as well.
Aren't market caps different? I mean, we can talk about the comparison of IT, but in 1990s, the market caps were not even $1 billion, even after a run-up. Now the market cap in most of the manufacturing companies is between $3 to $4 billion.
Yeah, so $3 to $4 billion, but look at it in context of the size of the economy. Look at it in context of what is the entire profit pool of the manufacturing sector in India. It's barely $2-3 billion. And look at and compare it with what it is where other countries have become a manufacturing hub, whether it is China or whether it is one of the Southeast Asian countries. They have all gone to become at least in tens of billions of dollars, if not hundreds of billions of dollars. And when that kind of a boom is coming into manufacturing, do you really want to second guess yourself in, okay, the multiples are looking too high, I'm going to there is going to be a 20-30%, maybe 50% correction, and so I am going to be play smart, sell right now and buy back later. It might so happen that the stocks run up initially from here, and these prices also might not be, you will not get an entry point at these prices also. Again, I am not suggesting this is the time to be going headlong into the market. Clearly signs are optimistic, but I am not so smart to be able to judge this is where the markets peak.
Okay. We've spent a lot of time discussing manufacturing. Let's have one last follow-up question on manufacturing. You like the AMS space, but last time when we spoke to you, you said that you were booking profits in defense and railways. Some would argue and say that that's also manufacturing. So are you booking profits in other parts of manufacturing?
So again, so as I mentioned, there are two parts to it, what market will do and what we should be doing. We should be doing is taking every step to ensure that you don't completely exit your position. So whether it is trimming your position, whether it is not deploying any more capital in that, see, you don't want to be making the mistakes at this point of time which make you regret later on. So you want to take some money off the table so that you actually, it's an option value more than anything else, where you actually hold on to the remaining part of your position for a much longer period. That is how you create that stomach to take the volatility, because at the back of your mind you have made good money in it, and if market build that worst case scenario out, if market corrects 20% and your stock corrects 30-40%, will you be okay? If that is the answer to it, then you've reached a stage where you have the ability to hold on to it much longer. And then if market does provide that opportunity, then you can use that cash that you've generated to add more to the position.
What is the right way of approaching PSU stocks? They were the ugly ducklings for last decade. Now they become the swans. The number of PSU companies which are now part of 1 lakh crore club is quite extraordinary. Do you think PSU stocks are on the verge of hitting what could be called as a flat curve, or there is still a lot of re-rating left?
No, so first of all, I don't like to segment the market in terms of who's the promoter. Of course, Government of India is a big promoter of a lot of businesses. Longer term, I don't think we should be, the interests are aligned of the government and the minority shareholders. But there are sectors where there is virtual monopoly, right? For example, defense. There are not too many companies that manufacture aircraft or helicopter or radars or those kind of things. There are only those few players. So there is a runway available to them. The private sector, by the time they come, it will be at least 5 years, if not 10 years from now. So there is a runway available for them. Clearly, those companies will do well. So instead of focusing on PSU versus non-PSU, I would say which are the businesses that excite me and which are the businesses that I want to own. Now, then I will see whether who owns that business and whether my interests and their interests are aligned or no. And in PSU, again, one more thing that we look for is there a right to win? Most of the PSUs don't have any right to win. What they need is a general bullishness in the economy for the stocks to do well, which is what they have been doing. The day there is going to be some kind of a dip in the economy or any kind of a challenge, that is where these companies will suddenly, the men and the boys will get separated. And I honestly feel it was only for example, in the banking space, it was only a reversion to mean trade. They continue to remain Me Too players. There is no special, there could be one odd PSU bank that has the right to win because of the depth and the penetration that they have. But in general, and it is a stated intent of the government that eventually there will be only 5 or 6 PSU banks left in this country. So you definitely want to be very selective and picky about which are the companies that you associate with.
So between 2023 Jan and 2024 Jan, have your top 4-5 holdings remained the same?
Good question. I am not very sure, but I would say, yeah, at least there would be 1 or 2 new ones that I've entered, more because of price performance rather than because I've placed a new bet. Clearly the last 12 months, a lot of stocks have done very well, and that is the reason why some of the stocks have come into the top 4-5 holding. It's not that we placed a big bet on it, but we run a very concentrated portfolio. So tends to happen that one particular stock doing well can increase it becomes a larger portion of the portfolio.
Okay. Couple of last questions. There are two big changes you've done in your portfolio. If I just take the clock back, you took IT completely out. You took, for example, pharma out. You've reduced the holding. Are there any large changes which you propose now we could see going forward, which could be radical changes in your portfolios, purely based on the thought process change?
Yeah, no. So clearly, as I mentioned, election is a big risk that we are carrying. For some, lot of our portfolio companies are beneficiary of the government strategy, government action, and too much dependence on that can be a challenge this year. Again, as I said, the theoretical risk is that the government changes, but I don't think that's going to be actually the case. But if that was to pan out, then my portfolio is carrying a lot of risk, and I definitely don't want to incrementally. I don't want to increase that risk. I would want to reduce that risk going into the elections.
A lot of believers in IT are of the view that, look, AI is just a passing phase. Y2K happened, enterprise happened, but Infosys, TCS, Tech Mahindra, they still are like top of the league companies. Do you think the AI fear is real, or AI is actually an opportunity? It may not happen this year, but it could happen in FY25 or 26.
No, so I clearly feel over a longer term period, AI is more a productivity enhancement. But in the shorter run, clearly it will create challenges. You mentioned Y2K. Y2K was a tailwind. Y2K was not a challenge for the IT sector. But if you remember, during Y2K days, these companies used to grow at 60, 70, almost 100% also. Today, now these companies grow at 8, 10. In fact, they struggle to grow at 8, 10%. One, their size has changed. And second, the business has become commoditized. And AI will actually commoditize it even further. So there are two things that the IT companies are running at. There is this old legacy business which is rolling off, and then there is this new business which is the digitization, which is picking up. But there is the one that is rolling off faster than the one that is growing. So at an aggregate level, these companies are not able to grow beyond 8-10%. And we have seen some of the stalwarts this year give guidance of 1 to 3%, and then within that 1 to 3% also further narrow it down to towards 1% rather than towards 3%. I think that is splitting hair. The fact of the matter is these companies are now commoditized, matured in nature, and they have not reinvented themselves. So giving a 25-30 multiple to a 8-10% grower in a good cycle, I don't think is a very smart thing. So that does not excite us. There is no re-rating possibility over here. So I would wait for the valuations to become so attractive in this case, where some amount of revival in growth can also lead to re-rating, which is what happened post-COVID, right, in most of the IT companies. But I don't see that today, so that is not something that excites me. On the pharma side also, there are different buckets, but the oral solid US focused generic business is not exciting. Over there, the negotiating power has shifted totally in favor of the buyers over there. The sellers in India are never going to make extraordinary profit. There will be one odd opportunity in complex molecule or one odd opportunity in biochemical drug.
Maybe injectable does well.
Yeah. So, but those trends are also now, injectable trend, for example, is now probably reaching its peak. Now, if you see, just take out and see the last 3 years announcement, every company is talking about getting into injectables. So there is going to be a supply, excess supply in that. And again, the same thing that happened in oral solid will play out in injectables also, where there are 15 suppliers and 3 buyers. So the profit pools are kind of shrinking, and these companies have also grown in size. So I would say that particular piece is not exciting. But there are again small niche opportunities which are coming up, whether it is CDMO, whether it is, there are fermentation based API is a small technology which is very different. The opportunity size is much smaller, but at the same time over here the negotiating power is actually in favor of the seller as compared to the buyer. So you have to find those profit pools which are more sustainable and can grow over a long period of time within pharma and healthcare, rather than brush everything with the same paint and say this is good or this is bad.
We respect SEBI disclosures, but we spoke about groups. There is no SEBI disclosure there. And last time when we spoke to you, I think 6 months ago, you said that you think that as a group, HDFC Group could make a comeback. The merger has gone through. Things are falling in place now. Could that be the comeback group for 2024 and beyond?
Again, I will refrain from
It's a
naming
group.
any company.
It's not a company.
But I say the financials as a theme is something that we continue to be bullish on. Large private sector banks have the right to win, which there was a case for the PSU banks probably to have a mean reversion in terms of valuation because the cycle was favorable. But if you look at which are the balance sheet which are strong, where it is far less leveraged, all the PSU banks are 15x leveraged. All the private banks are 3x, 4x leveraged. The ROEs have the room to improve from 13-14% to 17-18%. And this is exactly the kind of scenario that you want, where you want to play that cycle. A 3-5 years of some of the couple of the leader banks not giving any kind of a return creates the perfect base for you know to start thinking of placing bets in terms of from 3 to 5 years perspective. So